Hello everyone. Before we start today's lesson, please imagine the following scenario. You are in Europe, ready to go grocery shopping, but unfortunately, you have neither cash nor bank cards, and your only tool is your smartphone or smartwatch. Could you complete your purchase smoothly this time? In Sweden, the answer is yes. Over 95% of merchants already support digital currency payments. In the more familiar Eurozone, a monetary transformation called the digital euro is quietly taking place, reshaping the financial landscape. Today, we will explore three core questions to gradually unveil the mysteries behind the digital fiat currencies of European and American countries. Learning objectives for this lesson: 1. Understand the main motivations behind the push for digital fiat currencies in Europe and the United States, including addressing the decline of cash, safeguarding monetary sovereignty, and promoting financial inclusion. 2. Identify and compare the different technological approaches chosen by Europe and the United States for digital fiat currencies, along with the considerations behind those choices. 3. Analyze the opportunities and challenges brought about by the era of digital currencies, including their impact on the global financial landscape, individual lives, and regulatory systems. Why do we need digital fiat currencies? Let's explore together now. 1. The push from the demise of cash. In Sweden, cash usage fell from 40% in 2010 to less than 3% in 2025. People now buy coffee at bus stops with smartphones and pay subway fares with smartwatches, making physical cash a burden. The European Central Bank estimates that cash handling costs the Eurozone €50 billion annually, covering printing, transport, and anti-counterfeiting. Digital fiat currency thus represents an economic revolution over physical money. 2. The strategic game of payment sovereignty. By 2024, USD stablecoin USDT accounted for 68% of cross-border payments in the EU. This means for every $100 in international trade of European companies, $68 was settled through the US dollar system. What is even more serious is that traditional SWIFT transfers take 2 to 3 days, while digital currencies allow real-time settlement. A key goal of the digital euro is to build a self-controlled payment network and reduce reliance on the US dollar. 3. The ultimate solution for financial inclusion. In rural France, 12% of residents lack bank accounts and cannot access electronic payments. Digital currencies dual offline payment technology. No internet, no bank account is changing this situation. China's digital renminbi already supports phone-based offline payments, and the Eurozone plans to adopt similar tech. By 2028, the digital euro is expected to support smartwatches, IoT devices, and multiple terminals. Typical cases: the cent dollar of the Bahamas. As the world's first digital fiat currency, it addressed the challenge of distributing cash across more than 300 islands. By 2024, the cent dollar accounted for 18% of the country's money supply, becoming a model of financial innovation for small nations. Now, let's delve deeper into the three major technological approaches of European and American digital currencies. A context ranging from centralization to decentralization. the European approach, a security-first hybrid architecture. The digital euro adopts a TIPS RTGS hybrid model, which combines the real-time gross settlement system with blockchain technology. Its core design consists of 3 security layers. 1 identity verification layer, real name authentication through the EU Digital Identity Framework, ADAS. 2 transaction recording layer, a permission blockchain where only authorized nodes are allowed to record transactions. 3 risk control layer, transaction caps of 1,000 euros per payment and 5,000 euros in daily cumulative transfers. This architecture preserves the controllability of centralized systems while leveraging blockchain's immutability. The European Central Bank plans to invest 2.3 billion in quantum encryption research to counter the potential threat of quantum computers to digital currency security. 2. The US approach, a testbed for wholesale CBDCs. Unlike Europe's retail-oriented design, the United States focuses on improving efficiency in the interbank market. The Digital USD project, jointly developed by the Boston Federal Reserve and MIT, has completed 3 rounds of testing. Its key technological breakthroughs include 1. Smart contract engine. It enables conditional payments, automated clearing, and other complex financial agreements. 2. Atomic swap technology. It facilitates instant exchange between different digital currencies. 3. Privacy protection mechanism. It uses zero-knowledge proof technology to safeguard transaction privacy while maintaining regulatory compliance. In March 2024, the Office of the Comptroller of the Currency, OCC, approved Anchorage Bank as the first financial institution authorized to provide wholesale digital USD services, marking the official entry of the United States into the CBDC pilot phase. 3. The UK exploration, innovation within a regulatory sandbox. The FinTech Accelerator program, launched by the Bank of England, is testing 3 possible technological approaches. 1. Distributed ledger technology, enhancing settlement efficiency. 2. Central bank digital currency, CBDC, serving as the technical reserve for a potential digital pound. 3. Synthetic CBDC. It is issued by commercial banks but pegged to central bank digital currencies, forming a hybrid model. It is worth noting that the Bank of England has emphasized a strict 4 nodes principle for the future rollout of the digital pound. No replacement of cash, no mandatory usage, no infringement on privacy, and no disruption to banking system stability. What opportunities and challenges will the era of digital currencies bring? Let's continue our learning journey. 1. Opportunities reshape the global financial landscape. 1. Cross-border payment revolution. The BIS MemBridge project has enabled real-time cross-border settlements among China, the UAE, Thailand, and Hong Kong, reducing transaction costs by 60%. 2. Monetary policy innovation. The programmability of the digital euro allows for targeted stimulus, such as issuing consumption vouchers directly to eligible households. 3. Financial inclusion enhancement. The EU plans to provide basic financial services to the unbanked population through digital euro wallets. 2. Challenges. Triple test of technology, ethics, and regime. 1. Cybersecurity threats. In 2024, ECB simulations show that quantum computers could break existing encryption algorithms within 8 hours. 2. Privacy concern. Germany's constitutional court once ruled that mandatory reporting of digital euro transaction data violated the basic law. 3. Free risk of financial disintermediation. Deutsche Bank estimates that the digital euro could lead to a 270 billion deposit outflow from Eurozone banks. 3. Regulatory innovation. Lessons from the EU's MiCA regulation. The market in crypto assets, MiCA regulation, which came into effect in February 2025, has set a global benchmark for digital currency regulation. 1. Passporting system. A license obtained in any EU member state allows operations across 30 countries. 2. Strict oversight of stablecoins. Issuers are required to hold reserves fully matched to their issuance, with investments limited to Eurozone government bonds. 3. Enhanced anti-money laundering (AML) rules. Transfers above 1,000 euros must undergo mandatory identity verification, while anonymous mixers are fully prohibited. Now, let's look at a cautionary case. In 2023, the US stablecoin issuer Circle mismanaged its reserves, causing USDC to briefly lose its peg and triggering market panic. This incident directly prompted the EU to add a daily reserve audit clause to the MiCA regulation. How will digital currencies change our lives in the future? Let's continue our exploration. 1. The ultimate evolution of money forms. By 2030, we may witness the following scenarios. 1. Salaries are paid directly in digital euro into employees' wallets. 2. Smart contracts automatically execute mortgage repayments, with overdue payments triggering interest rate adjustments. Carbon trading is settled in real time through digital currencies, with each transaction carrying environmental footprint data. 2. The multipolarization of the global monetary system. According to IMF projections, by 2030, 1. The digital renminbi will cover 2 billion users. 2. The digital euro account for 35% of the Eurozone payment market. 3. The BRICS joint digital currency, BRICS Pay, will serve 40% of the world's population. 3. The return of personal asset sovereignty. Cold wallet sales have doubled for 3 consecutive years, signaling the arrival of an era when money no longer has to be stored only in banks. The concept of owning the private key means owning the asset is reshaping how people manage their wealth. Now, please reflect. In the digital currency era, how can we balance innovation and risk? How can we safeguard the functions of money as a store of value and a medium of exchange? Alright, everyone, today we have navigated through the fog of digital currencies, from the cent dollar in the Bahamas to China's digital renminbi, from Europe's hybrid architecture to the United States smart contracts. Digital fiat currencies are rewriting the very essence of money. This transformation is not just a technological breakthrough, but also a profound interplay of financial ethics and global governance. As future finance professionals, we must ask ourselves, in the era of digital currency, How can we balance innovation and risk? How can we safeguard the functions of money as a store of value and a medium of exchange? These questions will accompany you throughout your future career. That's the end of today's lesson. See you next time.